Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's get to some of the stories now we are following in the BNN Bloomberg newsroom. CTV News is reporting Prime Minister Mark Carney will announce measures today that will help Canadian steel producers and those in the softwood lumber sector. There are multiple reports that more financial aid will be announced for both industries. The news comes as steel, aluminum, and lumber continue to deal with high tariffs imposed by U.S. President Donald Trump. Shares of Teck Resources are edging higher, but 1% right now. The Canadian miners' proposed deal with Anglo American has received backing from the advisory firm ISS, which says the combination will produce positive strategic benefits. The deal still needs approval from Canada, the U.S., and China, but investors believe the recommendation will help advance the transaction. If approved, it would rank among the biggest ever in the mining industry. Brookfield Asset Management and Singapore's wealth fund GIC have offered to buy Sydney-listed National Storage REIT in a deal valued at more than $2.5 billion. The Australian self-storage company provider says its aim is to strike a deal by December 7th. National Storage operates more than 270 facilities across Australia and New Zealand. And looking at the markets right now, you can see the TSX still in record territory. The rally continuing. It's up 0.86% right now, pushing the year to 22.65%. And south of the border, similar situation. Everybody getting the green light today. S&P 500 and Dow Jones both up by 0.92%, and the Nasdaq's up an even 1%. And stocks are rising today, setting the major averages on track for their fourth consecutive day of gains ahead of the U.S. Thanksgiving holiday. One of the top gainers is Oracle, despite ongoing concerns about its corporate bond sales. Analysts argue that the recent sell-off is overdone. Let's welcome Eric Sterner, Chief Investment Officer at Apollon Wealth Management. And Eric, thanks very much for joining us.
Oh, Roger, thanks for having me.
So let's talk about Oracle off the top. People are saying it's undervalued. And they're undervaluing its partnership with OpenAI, but its credit default swaps have hit new highs. How do we balance all this?
Yeah, I think that was really, Oracle and all the hyperscalers really, it caused some concerns within the market. Certainly there's been on and off concerns about the high CapEx spending. But knowing that they went to the the bond market to issue some debt, we saw Google issue $25 billion in bonds, Meta $30 billion, Oracle $18 billion, Amazon $15 billion. I think it just caused some concerns amongst investors. But I think investors shouldn't be too concerned there, because these companies, the majority of these hyperscaler companies, their balance sheets are extremely healthy. And in fact, they still have very large cash balances. In fact, some of them could actually have more cash than debt. I think it's more of a strategic decision and capital efficiency to preserve some of that cash for other strategic initiatives. So I think the tech rally still has plenty of legs to go, including Oracle.
And relatively speaking to those companies, those bonds aren't that isn't that much, is it?
Exactly. It's those companies have very low debt. And so I think the market just was a little, took some time to digest that news, but it seems investors are back and the markets are back in the green today and have been over the last few days.
And now Google and NVIDIA tweeted, or on X, I guess we should call now, that its GPUs are a generation ahead of Google's AI chips. What do you think of that statement and doing it that way?
Yeah, it should be interesting. Obviously, NVIDIA has been the biggest of all the mega techs, and now we've seen a tremendous run. We've seen a tremendous run by all these mega techs over the past nearly 3 years, but Google has certainly just gotten a lot really strong returns over the past several days. So it'll be interesting to see as they go head to head with NVIDIA. And we know AI is, well, I think many of us believe AI is still very much in the early innings. So it'll be interesting to see how these two position themselves going forward.
And is there room for both of them, do you think?
I think so. I mean, this AI movement is so big, and it's going to really affect every sector in our economy. So I think and it's a worldwide phenomenon. So I think there's plenty of room for both. And I think there's, certainly plenty of earnings amongst both of them, as well as the other mega techs. So I think it'll be interesting to watch.
And now we're seeing, I was looking at some of the stories, the sleeping giant in global AI is how Google was described, is now fully awake. Is this just the start then, do you feel, for Google?
I don't know if it's just a start. I think it's just the continued the strong rally in technology that we've seen over the past 3 years. And I think, we still have plenty of room to grow. And while, there have been some pullbacks, and I think pullbacks within the market, especially technology, are healthy because, yes, these valuations are a bit frothy. I mean, you look at the top 10 within the S&P 500, their PEs are typically in the 30 range, while the other 490 are in the 19 range. But their earnings quarter after quarter between Google and these other top 10 companies are just outstanding. So they are priced for perfection. So eventually we may see some slippage within their earnings, whether it's past results or maybe even forward guidance. But right now, those strong earnings are continuing. So I think we still have plenty of runway with this rally.
And we've got the S&P up there right now. I want to get your thoughts on JP Morgan projecting the S&P 500 could hit 7,500 by the end of 2026, maybe even 8,000 if the Fed continues to cut. Deutsche Bank sharing a similar outlook. Do you think those are reachable?
Certainly, if I mean, there's plenty of risks that the markets are navigating. I mean, if everything goes as planned and we avoid some of those potholes within the market between a weakening labor market and rising geopolitical tensions, that's very possible because we've seen such strong earnings. We just saw the third quarter earnings, 4 straight quarters in a row of double-digit earnings growth. We see net profit margins at 13.1%, which is the highest since 2009. And even the revenue growth was at 8.4%, which is the highest it's been in 3 years. And all 11 sectors experienced higher revenue growth. So I think the corporate health of the S&P 500 companies is extremely strong. The weakening labor market is something to watch. I think this economy can continue to potentially grow with less jobs just because of all the productivity gains through AI and less labor supply with aging demographics and the limited immigration policies. So is it possible? Yes, but we need a lot of things to go right and to avoid any of those potential potholes, such as rising unemployment or any dent in consumer spending.
I want to try and get in 2 last things. What sectors are you currently favoring right now with everything that's swirling around? What are you looking at?
Well, I mean, healthcare had been in a rut, all year, and you see that it's not unusual with the new White House administration because there's policy uncertainty. But I think these weight loss drugs are, besides AI, the second most innovative trend in the markets right now. And now we've seen some of those hurdles clear. We saw some supply bottlenecks earlier this year. That's been cleared. The biotech companies have a new deal and working with the White House, where in return for lowering the cost of some of these drugs, they're going to get more coverage on these weight loss drugs through Medicaid, potentially, or Medicare and potentially Medicaid. And that's a huge industry. Just getting that coverage opens it up to 40 million more consumers. And it's expected that weight loss drug industry will be bringing revenues of $150 billion by 2030. So I think this healthcare has been an ignored sector really this year, and even 5 of the last 6 years has trailed the S&P 500. So I think there's plenty of room to rally within healthcare, and we just saw Eli Lilly become a $1 trillion market value. So I think there's more room to run there.
Okay, we're going to have to wrap it up there, but Eric, thanks as always for joining us.
Thanks for having me.
Eric Sterner is Chief Investment Officer at Apple and Wealth Management. Well, shares of Urban Outfitters are climbing today after the retailer reported strong Q3 earnings. BNN Bloomberg's Lindsay Biscaya will be here to help set the stage for the final quarter. That's up next. Shares of Urban Outfitters looking sharp today after the retail company reported strong Q3 earnings and an even stronger outlook for Q4. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya to talk about it. The holiday season, Lindsay, thanks for joining us. The holiday season just around the corner.
Yeah.
I'm going to get comfortable for a second. And,
get comfy.
And tell me a story about shopping. It's Black Friday coming up, and then Christmas. How are things looking? How did things look?
And it's such a big time for retailers, right? And surprisingly, things are looking pretty good for most retailers that we've been talking about, like the Gap, Abercrombie, and now for Urban Outfitters. Same story. And you mentioned, their stock price is just going up today. Last I checked, it's up over 10% at the moment. So it's one of the biggest movers of the day. Of course, trading on the NASDAQ. Record sales, record income for this quarter, for the third quarter, with sales surging more than 12% year over year. And also the fourth quarter also helps that share price to just go up today because there's a very positive fourth quarter, and we'll talk about that in a couple of minutes. But yeah, this follows reports of others doing just as well. As I mentioned, the retail sector seems to be doing well, despite the fact that people are a little bit worried about the future, both here in Canada and the U.S. when it comes to the economy. But when it comes to Urban Outfitters, important to mention they own Anthropologie, very popular store. They also own the brand Free People, and both that store and that brand really helped to drive up sales. And when it comes to Urban Outfitters in particular, it was women's denim that really helped to drive up sales, although they are really focusing on their menswear going forward. So just
good to know.
In case you wanted to go. Yeah, exactly. That was in the earnings call, talking about menswear as well, that they're focusing on that, mostly college-aged men, but hoodies, sweaters, everyone needs those.
Why are you looking at me like that?
And so the company's CEO was really talking about like consumer spending and how they do notice people are waiting for the holidays, but heading forward, like in this period right now, people are just kind of waiting and not buying at the moment. But in the third quarter, what they also noticed when it came to consumer habits was that people were okay with buying things full price.
Which is interesting.
Yeah.
I mean, there's been a lot of concern about Main Street, but yet people were still willing to spend.
Yeah, exactly. And if we're looking at the holiday season going forward, as I mentioned, people were okay with spending full price. Now, the CEO and president, Richard Hayne, he was talking about the fact that they're noticing a different trend, and that's people waiting for those sales, waiting for those promotions, which are obviously coming up today, if not tomorrow, or Black Friday. So they have noticed that slight shift when it comes to consumer spending, people being a little bit more aggressive, waiting for those deals, not buying things even online. They've noticed the trend of people putting things in their cart and then not checking out, so waiting to see if they can get promotions or a discount.
Oh, wow. Okay.
Yeah, on some of those items. And when it comes to other retail companies as well, like the Gap, Walmart, we've also noted that people are being a little more aggressive when it comes to looking for those deals too.
All right, and that's part of the fourth quarter. What about how's the whole fourth quarter shaping up?
Yeah, and the whole fourth quarter, a very positive outlook for Urban Outfitters. They expect total sales to grow in the high single digits for the fourth quarter, total revenue to also grow, profit margin growth by 25 to 50 basis points, driven by lower margins. That includes growth at both Anthropologie and their other brands that they carry. There's also the Nuuly side of the business. So this is where you can subscribe and rent a certain amount of clothing every month. And that is expected to do, it's been around since 2019. It's expected to do well, deliver mid to double digit revenue growth moving forward. And then just lastly, on this earnings call, the CEO and president was asked about prices, whether those are going to increase. And the company says they think any price increases are behind them. And they say they have very little need to raise prices in the very near future.
Okay, wonderful. Lindsay, thank you for that. BNN Bloomberg's Lindsay Biscaya. Coming up, Hot Picks. We'll zero in on 3 plays in U.S. healthcare after this. Well, the healthcare sector has been underperforming, and the S&P is creating a lot of good opportunities for the investors in that field. Earlier today, our Hot Picks guest, Alex Fitch, partner, portfolio manager, and director of U.S. research at Harris Associates, zeroed in on his favorite healthcare stocks. We kick things off with Centene Corp. Have a listen.
Just to start off really quickly, Harris Oakmark, we're long-term value investors. As I heard you mention, we haven't had many holdings in healthcare for a long period of time here. And the reason was that the valuations were reasonably high and we found better opportunities elsewhere. That's been changing in recent years, especially in the highly out of favor parts of the healthcare market, like managed care in particular. Managed care has been very challenged for the last 2 years here. Really been hammered by two things. One, we've had policy shifts that have made for an adverse mix impact. The second is that we've seen this very sharp acceleration in the cost trend in healthcare. And the combination means that in a lot of cases today, premiums just aren't adequate to reimburse the companies for the costs that they're taking on. That is especially true in Medicaid and in the exchange business. And Centene is really in the center of that storm. This is a company that's one of the largest players in Medicaid, one of the largest players in exchanges. And they somewhat predictably have had really sizable earnings headwinds in recent years. You've seen their EPS fall from something like $7 a share in 2023 and 2024 down to around $2 per share this year, and the stock has followed suit. The beautiful thing to us about managed care is that this is short cycle insurance. This is not property and casualty insurance where if you write a bad policy, you're going to be on the hook for 2 decades. Mm-hmm. This is business that reprices annually. And historically speaking, if I can slightly alter the old phrase, the thing that changes, the thing that fixes low margins is low margins. That's what we saw in 2015 when the exchanges were relatively new. We had too much capacity come in, but just 2 years later, we were back at peak margin levels. We saw that in 2020 as well. Today, I think we have all the precursors of that market recovery coming into place. All of the companies in the public market that operate in the exchange business are losing money in that business line today. CVS is saying they're going to exit the market. If you look at Medicaid, the public filings show that everyone across the industry on average is losing money and states are getting more generous on updates. Our opportunity is that investors are hyper-focused on, is the recovery going to be 3 quarters from now or 6 quarters from now? We don't really care when it happens as long as we're being adequately compensated to wait. This is a $39 stock where in a few years we can see them back at $7 of earnings power. 5.5 times earnings feels like that compensation.
We're tight for time. Molina Healthcare, what draws you to this one?
Molina, similar story to Centene, in the heart of the mess today with Medicaid and exchange exposure, but 2 wrinkles. First, I would say that it's the best managed company in our view in the industry. And second, it's the most efficient operator. And so in a world where the average Medicaid company is losing as a negative 1% profit margin, Molina is still making a positive 2% profit margin. And if we get back to the industry earning its cost of capital, Molina earnings need to more than double. The other thing that those 2 wrinkles provide to us is margin of safety. Their efficiency means this company is still earning $13 a share this year. This is a $145 stock. So we're paying 11 times trough earnings today. Like Centene, we think normal mid-cycle earnings are dramatically higher. And once again, when you adjust for that market recovery that we believe is likely, we're paying a mid-single-digit multiple of EPS.
Okay, so another health insurer there, or managed care. And then finally, a very different company. I always forget how to pronounce it. Is it IQVIA? They're a health data provider.
IQVIA, yep.
IQVIA, thanks.
A little bit of a different animal than the health insurers. This is a clinical research organization. And so what they do is they do clinical trials on behalf of pharmaceutical companies.
Okay.
The easy way to think about the business model is that this is just a growing royalty on pharmaceutical R&D spending. And that used to be a prized model. They grew at the high single digits. They earned high returns on capital. Over the last 3 years, though, the stocks really meaningfully underperformed the S&P 500. And the reason, the culprit, is really growth. COVID, as we all know, it drove a boom in R&D spending. A lot of work was pulled forward. IQVIA and its peers had their revenues overly inflated, and we've been through 3 years of really weak or even negative organic growth for the group. Our view is firmly that this has been cyclical, and not secular. And we're starting to see the tide turn here. Biopharmas are getting back to spending, and IQVIA growth is accelerating. In a lot of ways, it is what we think managed care could be 12 to 18 months from now, where investors are now becoming convinced that the bottom is in. They're becoming convinced we're set to accelerate from here, and stocks like IQVIA are up 50% off their lows. We still think we're early stages in this recovery. There's a lot of growth in pharmaceutical R&D still ahead of us. When we get back to high single-digit growth for the clinical research organizations, we suspect they won't trade at the 20 to 30% discount to where they used to anymore.
And Andy was speaking with Alex Fitch, Partner Portfolio Manager and Director of U.S. Research at Harris Associates. Up next, diversity and inclusion are gaining across Canada's venture capital and private equity sector, according to BDC Capital. We'll talk about that after the break. CTV is reporting that the federal government will announce measures this afternoon to help Canada's softwood lumber and steel industries. Multiple reports suggest the announcement will include more financial aid as well as further curbs on imports of foreign steel. The news comes as steel, aluminum, and lumber sectors continue to deal with high tariffs imposed by U.S. President Donald Trump. Globe and Mail is reporting the Canadian Securities Exchange is considering buying CBOE Canada and CBOE Australia. The report says talks are preliminary and there's no guarantee a deal will emerge. According to the report, CBOE is selling its Canadian segment because it is realigning its portfolio of businesses to sharpen its strategic focus. Shares of Dell are moving higher today, up 6.77% right now. The computer maker has raised its annual outlook for the artificial intelligence server market. The company says AI momentum has accelerated in the second half of the year, leading to an unprecedented amount of orders. Dell is boosting its shipment projections for the year to $25 billion US. Investors see the move as a sign of sustained demand for Dell's machines amid the current data center boom. Well, BDC Capital reports 88% of Canadian venture capital and private equity firms feature women on their investment teams. The company claims its investments in green initiatives and women and minorities will have a long-term financial return. To talk more about that is Paula Cruikshank, Senior Vice President of Fund Investments at BDC Capital. And Paula, thanks very much for joining us.
Thank you very much. Great to be here.
How does that number compare, the 88% to the last few years?
So we've certainly seen an increase. When we started the survey about 4 years ago, we were closer to 60%. So 66% was what we saw in 2022. And now we're, as we're announcing, getting a lot closer to 90%.
And is that starting to pay off? I know we don't actually have financial numbers yet on what kind of return you're getting on that, but you're seeing increased productivity and you're developing some metrics. Can we talk a little bit about that?
Yeah, sure. So basically, it's very early days to be talking about that impact. What we see is that innovation is moving forward with diverse viewpoints. So that's really the focus. This survey looks at benchmarking so that companies can compare themselves to one another. So basically the understanding for venture capital and private equity firms is that they're going to be able to have a pipeline of talent and be able to address succession issues as they move forward.
And what are the positives of bringing diversity, and are there any negatives or any concerns?
So we certainly see that there's positives, and we've reached out to our general partners, and they certainly see that there are some positives both at the general partner level and also in the portfolio companies that they're working with. So those portfolio companies can work with teams that are more likely to come up with new ideas. They're definitely able to, as I mentioned, have a pipeline for succession. But I think the other real advantage is, continuing to bring new talent in. I would say that's the one area we have a little bit of concern at this point in time. Last year, the numbers were higher in terms of bringing that diverse talent in at more junior levels. So we'll definitely keep our eye on it. But I would say that's probably the disadvantage, is that we're trying to make sure we keep our eye on junior talent continuing to be representative.
And now you launched as well $200 million platforms for Black and Indigenous entrepreneurs. How are things going with that?
So we were excited to announce the managing partner for our Black Entrepreneurship Fund. That was in February of this year. We're continuing to look for our managing partner for the Indigenous Fund. But in the meantime, we've been able to work with a number of Indigenous funds that are working with companies. So we continue to remain committed to that space. I would say the other space we're very active in is working with women-led firms. So our Thrive platform, which was announced in 2022, includes a lab where we can work with very early stage companies. It also includes a $300 million fund that we can invest in later stage companies.
And then you've invested about $1.6 billion since 2016 into clean tech and climate tech. What's been happening with that? What's the latest on that?
Yeah, there's been talk about how challenging that space can be. Certainly, it takes a long time for those technologies to be adopted, and the ability to prove out technologies in the environmental clean tech space takes a long time. So there's been quite a bit of government money put towards it. We're actually thrilled because we've been able to crowd in private capital there as well, and we continue to make progress. The benchmarking study that we were looking at really does show that both our general partners and portfolio companies see this as an important area to take action. So I would say that the conversation continues to happen, but we've got both a sustainability fund and a clean tech practice at BDC, and they're both making investments on a regular basis.
Okay, well, we'll have to wrap up there, but Paula, thank you very much for joining us. Paula Cruikshank is Senior Vice President of Fund Investments at BDC Capital. Up next, the SPAC craze is back, and it's weirder than ever. Bloomberg's Bailey Lipschultz is here to break down why investors could be setting themselves up for another painful deja vu. And Deere & Company's forecast for 2026 net income came in below estimates. We'll look at what that means for agriculture after the break. Well, the SPAC craze is back, and it's weirder than ever. Blank check firms cozying up to crypto treasuries and quantum tech, with some deals looking more like a financial turducken than sound investments. Bloomberg's Bailey Lipschultz is here to break down why investors could be setting themselves up for another painful deja vu and could find themselves in hot oil like a turducken. Thanks, Bailey, for joining us. Unwrap the turducken for us, will you?
Yeah, let's just start with where this metaphor comes from. It's normally a chicken stuffed in a duck stuffed in a turkey. And so the thing with SPACs, blank check companies, think back to 2020 and 2021, they were a backdoor way of going public. So there would be a blank check that would be listed. They'd agree to acquire a part of a private company. They then go public and take over their listing. Digital asset treasuries, on the flip side, are holding companies that hold crypto tokens. So if you look at the graphic, typical digital asset treasuries, crypto inside treasury company. Now that they're merging with SPACs, you're taking that and merging it with a SPAC. So you're taking the duck that's stuffed with chicken and you're putting it inside the turkey. Maybe it goes in the oven, maybe it goes in oil, to your point. But that's kind of where we are, at least for more than 8 companies that are working to get across the finish line, including 2 that'll have their votes on investor approval next week. And it does come amid market volatility and a pretty sharp pullback, broadly speaking, for Bitcoin and other digital assets.
Yeah, there is that pullback. What kind of an impact is that having?
It's definitely denting sentiment. And if you even go back further to call it the middle of summer, the poster child for this digital asset treasury kind of model was MicroStrategy, now renamed to Strategy. At one point, it was trading for more than 3 times the actual Bitcoin that it held. So it was a pretty solid arbitrage opportunity for the company, create shares or sell convertible debt, raise money, then turn around and buy Bitcoin. On the flip side, we've seen that premium compress to basically trading at the amount of Bitcoin that it holds. What that means, though, for these follow-on companies is that when they announced these deals back in the summer, when it was a much rosier picture, when everyone was striking these DAT deals, now we're kind of going to have to deal with that premium being sucked out. So when the deals do cross the finish line, the question is, where do they open? Are we going to see these shares that are trading for $10.15 opening at $6? Because that'll significantly burn those that hold on to the stock. That's kind of where we're at in terms of the SPAC DAT merger.
I think we're going to leave it at that and let you get ready for Thanksgiving. Happy Thanksgiving to you. Thank you, Bailey, for joining us. Bloomberg's Bailey Lipschultz. Well, shares of Deere are in the red today. The company's 2026 net income forecast did not meet expectations. Our next guest highlights risks to the company, including inflation, tariffs, and higher costs. Here to talk more about that is Michael Schliske, Equity Research Managing Director at Davidson & Company. Michael, thanks very much for joining us.
Hi, Roger. Thank you.
Just overall reaction to what we saw from Deere. Any of the numbers you like? What are the numbers that are concerning?
It was interesting. Almost every number, or almost every part of their outlook actually seemed pretty positive, except for the core U.S. farmer. And that's where the real challenge is. Deere's looking at a decline of 5 to 10% in their core heavy equipment market for 2026. That's obviously a very important part of their sales and of their earnings. But the rest of it, the smaller ag, the construction, all appears to be up next year. Even in the large ag outside the U.S., we're looking to see an up year in Europe and a somewhat flat year in South America. So it really does come down to one really important customer constituency that's causing this challenge.
And is there any way to make that up? Any opportunities elsewhere?
Well, right now that is the sort of lion's share of the revenue and of the earnings. Certainly, having growth elsewhere, they've tried to grow their ag and turf business on the smaller side. They certainly are seeing growth in their construction business as well, on the back of large infrastructure projects and data centers and other types of projects along those lines. There are also potential areas of upside, I think, for the core U.S. ag farmer as well. There are some additional government subsidies that are being considered. Deere has started to see some very early signs of dealer trends turning the last month or so. They mentioned on the call. So we're definitely not out of the woods yet, but Deere is starting to see some light at the end of the tunnel there.
And so what was having the biggest impact, or is a little bit of everything? Is it the tariffs that have been put in place? Is it the trade war that was going on with China, maybe even with Canada a little bit? Or is it just the agriculture industry struggling right now?
Gosh, it seems like it's all those things. They mentioned on the call they've got about a $1.2 billion headwind on tariffs to overcome in 26. They will overcome, I think, a lot of that, if not all of it. As far as the global policy is concerned, yes, they were excited that there is some sort of agreement with China on trade, which will help unlock the U.S. soybean trade. But in the end, it just comes down to the core crop prices. Are farmers planting too much or planting enough? Are their yields so great that there's a very large supply of crops that just makes the average price per bushel lower? They did mention some potential areas of increased demand next year, for example, expansion of E15 ethanol. So there are areas where things could get better, but at this point in time, given we haven't even started the calendar 2026 yet, they seem a little bit hesitant to get too aggressive.
And with that $1.2 billion, will they be passing that on, passing those costs on, do you think?
They have been passing most of it on, yes. It started out a little bit slow, but for the last couple of quarters now, and they think through 2026, they should be able to pass along at least from what we currently know about what the tariffs are, most of those extra costs.
And where might that spill over then? Are there other companies or other sectors within agriculture that might feel that effect?
I would imagine most of, yeah. I mean, Deere, for example, one of the competitors, AGCO, is largely known as a European. They have a large U.S. presence too, but Europe is more than half their business. That's an area where there's a little bit less tariff exposure. CNH is a little more balanced, which is the third tractor player. They're more balanced globally, but in general, it should be affecting just about everybody in that sector.
And now we heard from the head of Deere that if they felt 2026 would be the bottom. What was the reason for optimism, and do you believe him?
Yeah, I mean, we're about to wrap 2025, which is what I've called kind of the worst year for tractor sales in the history of modern agriculture. And 2026 might actually be even worse than that, it sounds like. But again, some of the earlier trends of seeing the smaller ag equipment get positive and be positive for all of 2026. They're starting to see some better parts sales. In addition, the inventory overhang they've had for the last 18 months or so has finally also dissipated. So now the retail sales and the wholesale sales will largely play in tandem with each other. Mm-hmm. And then, so that will also result in an easier comp year over year. And then finally, it does sound like policy from the White House will be more favorable towards the U.S. farmer over the next 12 months. That should at least make sentiment a bit better among farmers out there.
Okay, we'll wrap it up there. Michael, thanks very much for joining us.
Thank you.
Michael Schliske is Equity Research Managing Director at Davidson & Company. Still ahead, this Black Friday, consumers are skipping the TV and buying the dog food. We'll hear more from Bloomberg's Lily Meyer about the move away from wish lists and toward essentials. Stay with us. A Canadian research company has a promising drug that could offer a new treatment for multiple sclerosis, a disease that affects almost 90,000 people in this country. But the drug faced huge barriers getting to patients, not in the science of it, but on the stock market. In a three-part series, W5's John Woodward looks into the case of alleged stock manipulation. This is part 2.
In a lab east of Toronto, Dr. Andrei Kruchinski's team is hoping for a breakthrough in the treatment of multiple sclerosis.
There's no other drug targeting the same mechanism.
The drug, called Lucid MS, the company, Quantum Biopharma. Its founder and president, Anthony Derkach, says this video of its effect on mice shows the drug's potential.
It's incredible. It shows a mouse that has lost its ability to walk, and then after taking the drug, that mouse is walking again.
Derkach had hoped to raise money to fund these trials from investors in stock markets in Toronto and New York.
There is a very big potential.
Salim Ahmed bought about $100,000 in shares, thinking it would provide for his retirement.
And then started to go down.
Quantum's stock value was almost wiped out.
You thought something was up.
We had to start thinking something was wrong.
Quantum started looking at its trading data in detail. Most of their trades are done on the NASDAQ exchange in New York City, where they found a strange pattern. Millions of trades that were ordered but never completed, many over just seconds, in a way that seemed to push the price of the stock down.
We discovered there's a stock manipulation tactic that is called spoofing.
Stock spoofing is where a trader makes big buy or sell orders that they never actually plan to complete, just to trick other investors about where the stock price is heading. It's like pretending to order lots of pizzas just to convince other customers the market for pizza is hot, the price is going up, and then canceling all of those orders and making money by selling the pizza you already own.
And so the sale orders are there as a mask to try to push the share price lower.
But they had no way of knowing who was behind those American trades.
How did Canada's disclosure rules help you in this?
The main exchanges in Canada are much better at being able to provide information on the trading.
That Canadian data formed the basis of a lawsuit alleging stock spoofing on a massive scale. They claim 16 million fictitious orders came from Canadian bank platforms, around 12 million from CIBC, 267,000 from Royal Bank, and 3.7 million from someone their lawsuit calls John Doe. Quantum claims those orders were intended to and did send false and misleading pricing signals to the marketplace that interfered with the share price being determined by the natural forces of supply and demand. Total damages Quantum is seeking $700 million.
It is the banks and the brokers that have the responsibility to act as gatekeepers, to ensure that their clients and their traders are not breaching rules and regulations by the way they're trading.
And it sounds like you don't think they did their due diligence.
We do not believe they did.
In response, the banks deny they spoofed the stock. They say Quantum's data is cherry-picked and say Quantum fails to address the obvious cause of Quantum's declining stock price, its own mismanagement. Quantum never turned a profit and instead lost tens of millions of dollars each year. A U.S. court may decide the suit. Ahmed hoping regulators step in as well.
And that was part 2 of W5's John Woodward's report. Tune in tomorrow for the final part of this 3-part series. As U.S. consumers remain anxious about job security and the cost of living, some are using Black Friday sales, a period usually geared toward gift buying and the occasional personal indulgence, to restock on essentials. For more on this, we're now joined by Bloomberg's Lily Meyer. Lily, thanks very much for joining us. What is the shift? What are people looking for when it comes to deals on Black Friday?
Yeah, so it sounds like people, in addition to using Black Friday to get some holiday gifts, are really looking at it to stock up on essentials. So getting products they use in their everyday life, but buying multiple so that they can really make use of those sales.
And is there any particular focus for them?
Yeah, we've heard a variety of products that customers have been really interested in. In our story, we talked to someone who's planning to buy 3 bags of 40-pound dog food. People who are buying multiples of products like mascaras and sunscreens as well.
And what are they saying when you were talking to them? Are they doing this because they need to do it, or they just want to save some extra money, or do they really need this money?
I think people are really cautious about spending right now. I think they're feeling stressed about the economy and about prices getting higher. And so, they've said, we want to save where we can. And Black Friday feels like an opportunity where we can get essentials, but for a lot cheaper than, we would in just a few weeks.
And now this isn't something, though, that just started. It's been going on for a little while.
Yeah, so one person we spoke to said they initially started doing this last Black Friday. As it seemed like tariffs might become a possibility. They were really concerned about prices increasing, and so they started to kind of stock up on promotional events. And we also saw with Amazon Prime Day earlier this year, a lot of the hot ticket items were things like dish soap and paper plates.
Sorry, and what was, I just had a technical there, paper plates, and what was the other big one?
And dish soap.
Wow, people are looking at those things. Are we still seeing people shop for the big ticket items? Is there still an attraction for that right now?
Yeah, that's a great question. I wouldn't be surprised if we saw some of that spending over Black Friday. I think some retailers are pulling back on deals, but I think for the most part, people like to use it as an opportunity to cash in on some of those. But in addition, I think people will really be looking for deals.
And are businesses catering to those people that are looking for more of the essentials?
That's a great question. We haven't heard so much from the company perspective, but that will be interesting to see if more everyday items are on promotion than they have been in years past.
And so are they thinking? Sorry, I just lost my train of thought there. Are they thinking this will carry through into the new year? That this trend will continue? Does it make it worrisome for companies that focus on the non-essentials?
Yeah, what we've seen so far through retail reportings, earnings here, is that companies that offer really good value propositions are seeing shoppers spend. So For example, the Gap. Okay. The Gap saw higher income consumers trading down, and so I think people will continue to really be. All right.
I've got to cut you off there, Lily. I apologize. Thank you very much for joining us. We're out of time here. Bloomberg's Lily Meyer. That's it for us. We'll take a last look at the markets before we go. Have a great day.